Hi, everybody. It's Professor Mitchell, continuing with Chapter 10. In this video, we'll look at Section 10.4 on personal financial decisions. And we'll start with IRAs. An IRA is an individual retirement account meant to shelter income from taxes so that you can save it for retirement. Contributions to a traditional IRA are tax deductible, but all withdrawals are taxed. Interest earned is not taxed until withdrawn. However, contributions to a Roth IRA are not tax deductible, but withdrawals are not taxed. Therefore, interest is never taxed. For example, in 2021, you deposit $5,000 of earned income into a traditional IRA on January 1st, which earns an annual interest rate of 6% compounded annually. And suppose you are in the 30% marginal tax bracket for the duration of the account. First, we'll figure out how much income tax on earnings will you save for the year 2021. Next, making no more deposits, how much will you have after 48 years and after taxes are paid on the money? All right, so to find the amount of income tax saved, we will multiply the tax bracket by the amount of income. We're in the 30% tax bracket and we're depositing $5,000. So the amount of interest we're not going to pay on that $5,000 is $1,500. All right, and then using a formula from a previous section, the balance on this $5,000 investment after 48 years would be 5,000 times 1 plus 0.06 to the power 48, which comes out to $81,969.36. Now remember, after 48 years, when you withdraw that money, at that time, you have to pay taxes on it. So you get to keep 70% of that amount, which comes out to $57,378.55. All right, so it turns out there is this little fact about equivalence of traditional and Roth IRAs. With the assumption that your tax bracket does not change, the net earnings upon withdrawal from contributing P dollars into a traditional IRA account is the same amount as would result from paying taxes on the P dollars, but then contributing the remaining money into a Roth IRA. So the choice of traditional or Roth IRA kind of depends on when you want to pay the taxes. All right, in the next example, Earl and Larry each begin full-time jobs in January 2021 and plan to retire in January 2069 after working for 48 years. Assume that any money they deposit into IRAs earns 6% interest compounded annually. Earl opens a traditional IRA account immediately and deposits $5,000 into his account at the end of each of the next 12 years, $5,000 a year. Then he makes no more deposits. How much money will Earl have in his account when he retires? All right, so remember, Earl deposited $5,000 for the first 12 years and then stopped depositing anything. On the other hand, Larry waits 12 years before opening his IRA and then deposits $5,000 into the account at the end of each year until he retires. So remember, he's working for a total of 48 years, so he's depositing $5,000 a year for 36 years. How much money will Larry have in his account when he retires? And who paid more money into the IRA? I think that one's probably pretty obvious. And who had more money in his account upon retirement? All right, so starting with Earl, at the end of 12 years, Earl's account balance is found using this formula. And that comes out to $84,349.71. So now remember, for the next 36 years, he's just going to let that amount sit there and collect interest. So after 36 years, the amount in that account is going to be a whopping $687,218.34. Larry's account, which is an increasing annuity, only earns interest for 36 years. So the amount in Larry's account at the end of 36 years is going to be $595,604.33. Earl paid in a total of $60,000, while Larry paid in a total of $180,000. And yet, even though Larry paid more, he has less in his account upon retirement than Earl. The moral of the story, in case nobody else ever tells you this, is that money saved in a retirement account early in your career counts a whole lot more towards your retirement than money you save later. So as soon as you start working, right after college, start socking money away in a retirement account. All right, next we'll look at consumer loans. Consumer loans are paid off with a sequence of monthly payments in much the same way as mortgages. However, the most widely used method for determining finance charges on consumer loans is the add-on method. The formulas for the payment R and interest rate little r are the formulas you see here at the bottom of your screen. For example, you take out a 2-year consumer loan of $1,000 at an annual interest rate of 6% using the add-on method. First, we'll find the monthly payment, and then we'll find what would the monthly payment be if computed as a mortgage. And then finally, we'll determine what is the APR, or annual percentage rate. All right, so in this problem, P is 1,000, R is 0.06, and T is 2. So using the new formula, the monthly payment, big R, would be $46.67. However, if this was done at like a mortgage, the monthly payment would be only $44.32. This means that the add-on method results in the borrower being charged an additional $2.35 in interest per month. The problem with the add-on method is that each month the borrower is being charged interest on the entire principal, even though after the first month, part of the principal has already been repaid. And where you really see this is, for example, if you go to a home improvement store and they offer you 6 months financing with no interest, what they don't tell you, except maybe in the fine print, is that after that 6-month period ends, they are going to start charging you interest on the entire amount of the purchase and not just on the amount that you haven't paid off yet. In 1968, Congress passed the Federal Truth in Lending Act as part of the Consumer Protection Act. The law's stated goal is to ensure a meaningful disclosure of credit terms so that the consumer will be able to compare more readily the various credit terms available. The Truth in Lending Act requires a lender to disclose what is known as the annual percentage rate, or APR, for any advertised loan. For the preceding loan, the monthly payment of $46.67 corresponds to an interest rate of 11.134% when the payment is calculated the way we did in section 10.3 when we talked about mortgages. Therefore, the APR would be 11.134%. Home mortgages have a stated interest rate called the constant rate. However, some loans also carry points or discount points. Each point requires that you pay upfront additional interest equal to 1% of the stated loan amount. This has the effect of reducing the actual loaned amount. Steps to calculate the APR for a mortgage loan having a term of N months are as follows. Step one, we'll calculate the monthly payment, call it R, on the stated loan amount. Then we'll subtract all upfront fees, including points, from the stated loan amount and denote this result by P. And then finally, we will find the interest rate that produces the monthly payment R for a loan of P dollars to be repaid in N months. And as you will see, we are going to do that using technology because that turns out to be a very difficult algebra problem. All right, so the first step for a mortgage of $200,000 at 6% compounded monthly that carries 1 point, let's find the APR. So first, we will find the monthly payment on the entire loan using the formula from section 10.3. And that monthly payment comes out to $1,199.10. And if we're paying 1 point up front, 1 point means 1% of the amount borrowed. So when you subtract 1% of $200,000, you're left with $198,000. All right, so to calculate the APR, we will use technology. So in Excel or Google Sheets, hopefully you have access to Excel, but if not, everybody has access to Google Sheets. They work exactly the same way. This is the formula that we're going to type into Excel or Google Sheets. So let me show you how that looks. All right, so I've opened up Excel. And I've made the font bigger and the column wider just so you can see it easier. You don't have to do this when you're doing it yourself. So what I'm going to type in is equals. You always start a formula with equals 12 times, and then we're going to put the word rate. And as soon as I put a parenthesis, this little cheat sheet comes up that helps me remember what all the parameters are for this formula. So the first one is the number of periods, which for a 30-year mortgage would be 360. Next is the payment. So for a decreasing annuity, that needs to be a negative number. So that would be negative $1,199.10. PV stands for present value. So that would be 198,000. And then for the last parameter, you might be able to actually leave that blank, but we're going to put 0 for the future value. All right, so what we get is 0.060939, et cetera, et cetera. So we'll round that to 0.06094. And that's how we get an APR of 6.094%. So in general, whenever you use this formula, and again, it works in either Excel or Google Sheets, you're going to go 12 times equals 12 times rate, and then you put the number of periods, the monthly payment with a negative sign in front of it, the present value, and then lastly, put 0 for the future value. All right, that brings us to effective mortgage rate. The APR is of limited use because it is relevant only for loans that are kept for their full terms. The average mortgage is refinanced or terminated after around 5 years. The effective mortgage rate takes into account the length of time the loan will be held and the unpaid balance at that time. So steps for calculating the effective mortgage rate for a mortgage loan expected to be held for M months. First, calculate the monthly payment on the stated loan amount. Then subtract all upfront fees, including points, from the stated loan amount and denote that result by P. And then determine the unpaid balance on the stated loan amount after M months, and we'll denote this result by B. And then finally, we'll find the interest rate that causes a decreasing annuity with beginning balance P dollars and monthly payment R to decline to B dollars after M months. Kind of feels like alphabet soup, doesn't it? Right. Okay. So for a mortgage of $200,000 at 6% compounded monthly that carries 1 point, let's find the effective mortgage rate, assuming the mortgage will be held for 5 years. So using the 4 steps we just went through, first step is the same as in the previous problem. The monthly payment on the whole $200,000 is $1,199.10. Once points are deducted, the principal is $198,000. All right, and the mortgage has 300 months to go. Therefore, the unpaid balance after 60 months would be found using this formula: $186,108.55. So using the Excel rate function, the effective rate would be about 6.25%. So notice for the future value, instead of putting 0, we're putting negative B. All right, I'm not going to say a whole lot about this slide. This is just for your reference. The significance of discount points, depending on the lifetime of your mortgage, and the difference between the effective mortgage rate and the stated interest rate. All right, so to summarize, an individual retirement account, or IRA, is an increasing annuity in which the annual interest earned is either tax-free in the case of a Roth IRA or tax-deferred in the case of a traditional IRA. Contributions are tax-deductible only with a traditional IRA. When finance charges on a consumer loan are calculated with the add-on method, the interest paid each month is a fixed percentage of the principal rather than a fixed percentage of the current balance. For each discount point accompanying a mortgage loan, you must pay additional interest upfront equal to 1% of the amount borrowed. The APR and the effective mortgage rate, which take upfront fees into account, are often more useful than the contract interest rate in appraising a loan. Each of them makes use of the reduced loan amount obtained by subtracting the upfront fees from the stated loan amount. Finally, the APR is determined by calculating the interest rate corresponding to the reduced loan amount. The effective mortgage rate also takes into account the expected lifetime of the loan and is the interest rate corresponding to an annuity that decreases the reduced loan amount to the balance after the expected lifetime of the loan. And that's going to do it for section 10.4. We will see you next time.